There are 5 things sitting inside your financial world right now that the IRS is going to tax the second you walk away from work, not because you made a mistake, but because of where those assets are sitting. And the time you have left to reposition them is shrinking faster than most people understand. What I'm about to walk you through are 5 specific financial positions that the IRS handles differently depending on whether you reorganize them before your final paycheck or after it. The gap in actual dollars is 6 figures across a 25-year retirement, not theoretically, but mathematically. If you are within 5 years of stepping away from work, this is the most critical tax video you will watch this entire year. Every single one of these 5 strategies becomes dramatically more costly or entirely out of reach once you stop earning a paycheck. The tax brackets shift. The income flexibility vanishes. The IRMA look-back locks in permanently. And by the time most retirees figure out what they should have done, that window has already closed. Before I continue, I need to be very clear. I am not an attorney, a CPA, or a licensed financial advisor. Nothing in this video is legal, tax, or investment advice. These are educational illustrations based on current tax law and publicly available IRS information. Always consult a qualified tax professional before making decisions about your specific situation. My name is Nancy, and welcome to USA Senior Guide. This channel exists for one specific audience, retirees and pre-retirees over 60 who want to understand how the IRS truly works in retirement. Not the version your HR department gave you, the real version with real numbers in plain language. Subscribe right now because next week, USA Senior Guide is releasing a video on the exact month you should retire to minimize your taxes. Drop a comment right now with how many years until you retire. Just the number. I read every single one. Number 1, sell your high turnover mutual funds inside your taxable brokerage account. If you own actively managed mutual funds in a standard taxable account, those funds are generating taxable events every single year, whether or not you sell anything. The fund manager constantly buys and sells stocks. Every winning sale creates a capital gain that gets distributed to you at year end. You owe taxes even though you never made a decision. High turnover funds carry turnover rates of 80 to 120% annually. The tax burden compared to a low turnover index ETF can amount to 1 to 2% of your balance per year in completely avoidable taxes. On a $200,000 account, that is $2,000 to $4,000 per year. Over 10 years, $20,000 to $40,000 quietly gone. The fix must happen before you retire. Begin transitioning high turnover mutual funds into tax-efficient index ETFs now, but do it gradually. Sell positions with smaller gains first. Hold positions with large embedded gains until your first retirement year when income drops, and you can potentially harvest those gains at 0% federal tax. In 2026, the 0% long-term capital gains rate applies to single filers below $49,450 and married couples below $98,900. Every year, those high turnover funds stay in your taxable account is another year of unnecessary drag. A viewer contacted USA Senior Guide last month who had held a high turnover international fund for 12 years. When he finally added up 5 years of capital gain distributions on his 1099s, he had paid over $11,000 in taxes on gains he never chose to realize. He switched to an index ETF in one afternoon, and the bleeding stopped that day. Number 2, convert your traditional IRA to Roth before you retire. Every dollar in your traditional IRA is money the IRS has not yet taxed. At age 73, they force you to pull it out through required minimum distributions, taxed as ordinary income on top of Social Security and any pension. The effective rate on those RMD dollars can reach 30 to 40%. The alternative is converting during the gap years, the period between your last paycheck and age 73 when your income is at its lowest. No salary, possibly no Social Security yet, no RMDs. In 2026, a married couple can fill the 12% bracket with roughly $133,000 in taxable income. A couple who converts $300,000 over 5 gap years at 12% pays about $36,000 in federal taxes. That same amount forced out as RMDs at 25% costs $75,000. The conversion saves $39,000 on the exact same money. While you are still working, your salary fills the lower brackets completely. Every conversion dollar stacks on top and gets taxed at 22% or higher. You need to plan your exit so the gap years begin the moment your salary stops. If you are within 3 years of retirement, contact a tax planner this month, not next year. Also remember that every Roth conversion counts as income for IRMA purposes. A conversion in 2026 can affect your Medicare premiums in 2028. Model the IRMA tiers carefully before you pull the trigger. Did you already know about the gap years? Drop yes or no in the comments. This single concept changes entire retirement timelines, and I want to know how many of you are hearing it for the first time. Number 3, harvest your appreciated stock at 0% capital gains while you still can. In 2026, if your taxable income is below $49,450 as a single filer or $98,900 as a married couple, you pay 0% federal tax on long-term capital gains. That means you can sell appreciated stocks or ETFs in your taxable account, owe nothing in federal tax, and immediately buy them back at the higher price. Your cost basis resets. Future gains are calculated from the new value. You erased years of embedded gains without paying a penny. This window exists for only 3 to 5 years for most retirees. Once Social Security starts, once RMDs kick in, once your pension begins, taxable income climbs above the threshold and the opportunity disappears. A married couple retiring in 2027 with $30,000 in IRA withdrawals as their only income sits well below the threshold. If they hold 3 positions with total embedded gains of $54,000 and sell all 3, they owe 0 in federal taxes. They immediately repurchase similar ETFs at the new higher basis. If they had waited until age 75 when RMDs push their income above the threshold, that same $54,000 in gains at 15% would have cost them $8,100. That is $8,100 saved simply by acting a few years earlier. Number 4, move your bond funds and REITs out of your taxable account. This is about asset location, not asset allocation. Bond interest and REIT dividends are taxed as ordinary income. Sitting in a taxable account, they add to your adjusted gross income, push more Social Security into the taxable zone, and can trigger IRMA surcharges. Those exact same investments inside a traditional IRA generate the same income, but you pay no tax until withdrawal. Inside a Roth IRA, you never pay tax on them at all. Before you retire, sell your bond funds and REITs from the taxable account and purchase them inside your IRA or Roth IRA. In the taxable account, hold tax-efficient index ETFs producing primarily long-term capital gains. Correct asset location can save 0.5% to 1% of your portfolio annually. On a $500,000 portfolio, that is $2,500 to $5,000 per year, or $62,500 to $125,000 across a 25-year retirement, without changing your allocation or your risk at all. Do this while you are still working because active contributions make it clean. After retirement, there are no new inflows, and repositioning can itself create taxable events. If you have made it this far, hit the like button right now. It takes 1 second and tells YouTube to show this to more pre-retirees who need it. Subscribe to USA Senior Guide if you have not already. Next week's video on the best month to retire is going to save some of you thousands of dollars. Number 5, sell your high-tax state residency. 9 states have 0 state income tax: Florida, Texas, Tennessee, Nevada, Wyoming, South Dakota, Alaska, New Hampshire, and Washington. 3 more, Pennsylvania, Illinois, and Mississippi, exempt all retirement income entirely. Compare that to California taxing retirement income up to 9.3%, or New York taxing everything above $20,000 in pension income, or Minnesota still taxing a portion of Social Security. For a retiree with $60,000 in annual income, The difference between California and Florida is roughly $3,500 to $4,500 per year. Over 25 years, that is $87,500 to $112,500. That is not a lifestyle choice. That is a six-figure financial decision. This move must happen at or before retirement because state residency rules require establishing legal domicile, updating your license and voter registration, and spending the majority of the year in the new state. Every year you delay costs you the full annual difference, and this decision interacts with every other move on this list. Roth conversions in Tennessee cost 12% flat. The same conversions in California can cost 21 to 23% combined. The difference on a single $100,000 conversion is $9,000 to $11,000. USA Senior Guide is not telling everyone to move. If your family, grandchildren, and entire life are rooted where you are, do not uproot everything for taxes alone. But if you are already considering a change, add the tax number to your decision. For many of you, it will be the factor that settles it. Let USA Senior Guide bring all five together in one example. A married couple, both 63, hold $400,000 in a traditional 401k and $150,000 in a taxable brokerage account. They live in California and plan to retire at 65. Move 1, they replace high turnover mutual funds with index ETFs. Annual savings $2,000, lifetime savings $50,000. Move 2, they convert $50,000 per year for 5 years at 12% instead of facing RMDs at 22% or higher. Tax savings $25,000. Move 3, they harvest $60,000 in embedded capital gains at 0% in their first retirement year. Tax avoided $9,000. Move 4, they relocate bond funds from taxable to IRA. Annual savings $2,000. Lifetime savings $50,000. Move 5, they move from California to Tennessee. Annual state tax savings $4,000. Lifetime savings $100,000. Total lifetime savings across all 5 moves, approximately $234,000. Same couple, same money, same retirement, $234,000 more in their pocket because they acted before the window closed. Every one of these moves is completely legal. Everyone is documented in the tax code. The IRS does not prevent any of them, but the IRS also does not tell you they exist. The system collects the maximum from people who never ask the right questions. These 5 moves are the right questions. Here is what USA Senior Guide wants you to do right now. First, open your taxable brokerage account and look for high turnover mutual funds and bond funds generating ordinary income. Those are positions 1 and 4. Fix them. Second, check your traditional IRA or 401k balance. If it exceeds $200,000, you need a Roth conversion plan before you retire. Talk to a fee-only tax planner this year, not next. Third, calculate your embedded capital gains in your taxable holdings. If large gains exist and retirement is within 2 years, plan the harvest for your first low-income year. The 0% window does not stay open long. Drop a comment telling USA Senior Guide which of the 5 moves surprised you most, just the number 1 through 5. The most common answer becomes next week's deep dive. Hit like, subscribe to USA Senior Guide, and do not miss next week's video on the best month to retire. It is going to change the timeline for a lot of you.